We are ready. So thank you, Jonathan, for joining us today, the NJ Environmental Fundraisers Gathering. And today's topic's really interesting. So I'm going to hand it over to Jonathan to kick us off.
Okay, so I'll just before I put up my slides, because it's a little impersonal, I'll just say that I've been who I am. I grew up in Parsippany, New Jersey, so I know the area really well. I live in Passaic, New Jersey still. So I've basically been in New Jersey almost my entire life. I'm a lawyer. I've been a lawyer since 1994. And I've been specialized more after practicing regular type law, criminal defense, and anything under the sun. Coming out of law school, I eventually got into work with not-for-profits, but also estate planning, usually in regard plan giving, which is estate planning, but in regard to helping not-for-profits. I worked for some large ones, or for Anti-Defamation League, or United Jewish Communities. And eventually, I moved into consulting, and I still practice law. So I'm doing sort of both the basic estate planning type work, but I'm also plan giving, coaching, training, doing different types of programs to help not-for-profits get some traction in this area. And then I give a lot of speeches on tax law. Sounds like why? But I'm really focused more on, I've been giving a lot of talks on this since 2018. That was my first big tax bill. Then was a lot of changes. And then so I've spoken to hundreds of people on this topic. So I try to, for fundraisers, I'm trying to keep it simple, but I do want to mention, I decided not to try to address the environmental issues in the bill. That's beyond my expertise. Number one. Number two, I just not. So I looked at it this morning. I said maybe I should mention that. Okay, it's probably not so good for environmental groups. A lot of different things were taken away. So I'm just going to say that to begin with and not go any further on that topic. But if you came to hear that, I'm sorry. I'm not. That's not my. I'm more tax related in terms of givers and people and deductions and a couple other things there. So I'm going to go through a pretty short PowerPoint deck. Feel free to ask a question during it. You could text a question, or you could just say, hey, I got a question. And this is really sort of some of the stuff I'm going to cover. Let me just do my share screen right now. Let's see the over the shoulder thing. Okay. And let's do the background thing. Okay. And then I'm just going to give me a second to hit the right screen. I just got to do the sorry, take a little time to get that going. Okay, so yeah, feel free to ask questions during this. I don't mind. It's a small group, and hopefully you'll share the recording. And I've cut this down a bit. I'm independent attorney, New Jersey and New York attorney, but I do a lot of work at plangiving.com. So give them credit, and we've done this. And this title was really for a bigger presentation we gave, so I cut this down quite a bit. So I just want to show everybody one slide at the beginning. This is a little off topic, but not really off topic, because I talk a lot about plan giving and why it's important. And I just want to circle that. Yeah. So this, I just always wanted what should be jumping out at us. So this is right out of Giving USA. I copy and paste the numbers into Excel spreadsheet. It's Excel or PowerPoint, and this is looking at individual giving, inflation adjusted since 2016. And I originally did this slide saying, oh look, there was a huge drop between the peak year in individual giving 2021 to 2023. That was a pretty big drop. But then I realized there was a bigger message, and that really has to do with there was a lot of money in COVID money out there, and people were very generous and they gave it to charity, a lot of it to charity. And then of course there was a couple inflationary years, which was not great for not-for-profits. But the bigger story I really want to show everybody, just to keep this in mind, for many years, I've been giving these speeches on plan giving for 15 to 20 years, and I always end my beginning sections with, at some point in the future, fundraising is going to flatten out. I mean, individual giving is going to start flattening out, because eventually the baby boom is sort of be a tipping point. The baby boom is basically driven giving for so many years, for decades. Giving is usually going up, and maybe a recession hits and it goes down a little bit, and then comes back even better usually after the recession. But at some point in the future, I'm always predicting, hey, by the way, at some point maybe it'll be flattening out, or even going down. So then I finally realized, looking at it, I was a couple years late. It's hard to realize that. Look at total individual giving 2023, 373 billion. is basically less than 2017 or similar to 2016. And I realized, see, that I put a flat line here. So I just wanted to show you, not-for-profits need to beware. And, a lot of different factors that affect giving. And one of them is this, that at a certain point, the growth in giving is going to not be growing anymore. It's going to get stale. It's going to get clogged up because it's just not enough. The baby boomers are sort of leaving the scene one way or another. That's a nice way to put it. 37% of baby boomers have passed away. So just making that point to everyone is that, not-for-profits really obviously need to get their act together in terms of getting younger donors, different ways of giving, online giving, anything to engage people and keep people engaged over time. And then planned giving is really capitalizing on the lifetime relationships your organization have had with donors, and those gifts can make a big stopgap for these tough years. And these are tough years. Basically, fundraising's been flat for almost 10 years. Individual giving. Now, other types of giving have gone up, but we usually focus on individuals. All right, so that's my little plain giving pitch to start. All right, so let's talk about the tax bill. I'm going to mention it. I have the PowerPoint and you have the handout. So a couple different things. Yes, they took the expiring tax rates and brackets and they made them permanent. There's no such thing, by the way. There's a law when it comes to taxes and stuff. There's no such thing as permanent. Permanent is just another word for saying something is not expiring. But there's no such thing as permanent tax law because the Congress can always change it. So what this means, though, is that the tax rates that were put into effect in a little bit lower tax rates in 2018 now are not set to expire. So, but as soon as there's another change in Congress and president or a combination of both, somehow there could very easily be changes in this regard. Okay, so and then they made permanent again the standard deduction increase. So the standard deduction, just to remind us all, and this helps us with fundraising. It's one of the big points that's going to come out of this. Each of us have here I'm going to circle. Each of us individually have a $15,750 automatic deduction. So regardless of what we gave in charity and paid on mortgage interest and taxes, if all those other things don't exceed $15,750 per individual, obviously double it for husband and wife, joint filer, or $23,000 is for the head of household filer. If you don't exceed that, it's not the end of the world. Whoever does your tax return or you do yourself, you just take the standard deduction. All this stuff is computerized anyway, so you can do all your best to show your accountant all these receipts for all your charitable gifts and other things that might. But if it doesn't add up to these numbers, then you just use these numbers, and that's not a bad thing. That's just a reality. Now, there was a big concern after the 2018 tax bill, which basically reduced the number of itemizers. An itemizer is somebody who does not use the standard deduction, so it reduced the number by a tremendous amount of people, and there was a concern that fundraising would just drop out because all of a sudden, 2/3 of the bulk of money from people who are itemizers are no longer itemizing. And if you don't itemize, you technically don't get a tax benefit for your charitable giving. Now, they addressed it in another way, which we'll get to in a second. So it's just good to know how it works. And they added just for informational purposes, they added a new senior deduction. I forgot the number. I think it starts at age 65, but I could be wrong. So don't hold me to that. So now if you're 65 plus, you could get an extra deduction for $6,000. And the point, this was really more of a campaign thing where they say, well, we don't want to tax people on the Social Security, but they basically created a way to, they said, well, if we give everybody, but not the high earners, there's an income limit. So 75,000 is your AG gross income. Can't be above 75, 150 for joint filers. So if you have a low enough income, and you're a senior, you get a $6,000 deduction, which is really meant to offset taxes on Social Security. Okay, but it's like a backdoor way to try to help seniors. They're not actually connected so they estimated about 88% of seniors no longer will be paying. Just assuming they have this, and it's only for a couple of years. This one expires 2025 to 28. Okay, so seniors get an extra deduction. Doesn't really affect us so much. They increased the child tax credit. That's it for children 16 and younger. Anyone who has children that those ages, they get a literally tax credit. Now it's actually up to 2,200 per child, again up to age 16, and will be going up. And it's great if you have younger children, you get that deduction. A tax credit. It's very important to understand what a tax credit is. By the way, a tax credit is it's actually essentially you paid 2,200 in taxes. So I have a 12-year-old, and so when my accountant does my tax return, I'll get the $2,200. Well, that's in 2026. So 2020, I think it's $2,000. I'll get the 2,000 in 2025, and I'm just doing. It happened today. I was just doing my 2024 taxes. I think it was 2,000 then. So I'll get credit for having paid taxes, $2,000, even though I didn't actually pay anything. But that again, it goes towards my total tax bill. I actually saved $2,000 taxes that I would have had to pay. They made they did something in mortgage interest deduction. So when you pay your mortgage, one of the advantages of owning a home is you get to deduct the interest. But they say, well, for loans above 750,000, the interest on the part above 750, you're not going to be able to deduct that. Okay, it doesn't affect that many people. The people it does affect, it's kind of negligible. And they for us in New Jersey, especially those in Passaic and Essex County, but maybe other counties, they increased the cap on itemized deductions for state and local taxes to 40,000. What this meant was, prior to the 2018 law, you could deduct all of your real estate and state income taxes. That would all be deductible on your federal tax return. And then in 2018, they capped it at $10,000. So people really suffered. Actually, you lost a lot of money if you were paying typically high real estate taxes. So you can no longer deduct beyond 10,000. So now for 2025, starting already is this year through 2029. Again, they put a cap on these types of things because the numbers, future numbers calculations don't get all thrown off if they give this away for too long. So for now, they have this. So for example, my friend, a guy I work with, who he earns a lot, he pays over 40,000 a year in real estate taxes. Believe it or not, in Passaic, New Jersey, he's got a very big house and very big property. Up until this year, he was only able to deduct 10,000 of that, and that's for him that's about $7,000 or $8,000 tax break. So he got a nice tax break for this year. So those in the high tax areas got extra bracket. But it used to be we got 100% deduction on all of our state local that stands for SALT, state and local taxes. So now they gave it back. For me, I'm pretty much covered for all. For my real estate taxes and for the state level income taxes, I'll get to deduct it all. So I guess I get a bonus come next year, not for 2024, which I'm still working on today. Okay, now we get to the charitable portions, and my goal is just run through these slides, and then we'll sort of take off the slides and we have some conversation about this. They did some interesting things here. They created a 0.5% floor on itemized deductions for charitable contributions. And like, even me, who I understand, so I was like, what does that mean? I'm going to show it to you in the numbers a second. So basically, they're taking away 0.5% of you're giving $100,000 first. I think it's first. Let's see. Hold on. Let's say 5%, 10% of 100,000, 10,000. 5% is 5,000. So it's $500. The first $500 of a $100,000 gift is not going to be deductible. Basically, that's what's not going to show it to you on paper in a second. And then they put a cap on the value of your deductions when you're above 35%. Again, I'm going to explain that to you in a second. So the value, it's basically taking. I'll show you how it said it's for very, very high earners. They're starting chipping away at their charitable deduction a little bit in the beginning and a little bit at the end. The higher part. I'll explain that later. There was an increase in the alternate minimum tax, which I never understood, so you don't have to worry about it. But that was good. It's a good thing because alternate AMT was a problem for charitable giving, so we're happy it's here, but let's not worry about that bullet point. And then the big news for us, which this is the most practical point, which everybody should be aware of and understand. There's now a new $1,000 above the line deduction. I'll explain what that is in a second, what that means for charitable contributions, and $2,000 for joint filers. So each husband and wife, your tax return, you will get a deduction above the line. Above the line means that it's similar to like putting money in your IRA. It reduces your it even reduces your adjusted gross income. So you have like gross income, all your 1099 income and interest income from the bank and all stuff. And then you have like above the line deductions. The first round of deductions is called above the line, and like IRAs. And then we're not even talking about the standard deduction thing, which is going to come next in your tax return. So this is very, very nice. I think I put here. Yeah, and I put here. Sorry, I'm not going to discuss it. They repealed a bunch of Inflation Reduction Act, green energy tax credits, and that's probably a separate whole session that I'm not qualified to give. So I'm going to move on from there. And just now, I'm trying to explain to you what this 0.5% floor means, and then I'll explain what the other thing means. So anyway, so just look at the calculation here. So if I multiply 0.5% times, let's say a 200,000, this was so confusing, by the way, a 200,000 AGI adjusted gross income, then you get is it $1,000. 0.5% times 200 is 1,000. So you get no deduction for the first $1,000 in charitable gifts, which is just kind of silly. I mean, it's basically I call these things a backdoor tax. They call, oh, we're reducing taxes. This is a trick that all parties do, by the way. Oh, we're reducing taxes here, but they're really raising taxes over here. So this is exactly what's going on here. And they're basically taxing you not directly, but indirectly by reducing the value of your charitable tax deduction for those who can use it, who are obviously itemizers. And so that's what it is. So basically, and there's nothing you can do about it. There's no way around it. There's one idea we'll talk about in a second, but essentially there's really it'll be all calculated in when their accountants do their tax return. It'll be calculated, and you'll lose some of the value of your deductions. And then there's this cap I started to talk about in the last slide. A cap on the tax benefits of itemized charitable deduction at 35%. What does that mean? Now remember, the highest tax bracket is 37%. Now I'm going to be honest with you. Very, very few people are paying the 37% marginal bracket. You have to be earning well over $500,000 of like taxable income. And by the way, the first, let's say $500,000 of income doesn't even pay 37%. The way it's graduated. So whatever level, the first 500,000 is broken into these different levels of the tax brackets. And so I would say, I did a calculation, it's probably, if you're right at the 37% bracket, you're probably paying about 24% is really what you're paying. So it's not affecting your charitable gifts until you go way past that $500,000 earning level. And at that point, you're never going to get a full 37% break. So like on 100, let's say, let me read this, what I wrote here. In other words, the high income filers, if they donate $1,000 in this, they're going to get $350,000. They're going to get the value of a $350,000 deduction instead of $370,000. They're losing what's called 2 cents. So they're only, even though they're paying the 37% bracket, but it's not on all their income. It's only on the highest part of their income. And the truth, and it starts next year. That's an important point. There may be I think one practical things that might come out of this, financial advisors to wealthier individuals, to high net wealth individuals, may suggest to their clients, hey, the government's sort of chipping away at your deductions, your charitable deductions, and why not put aside money for future year's gifts in a donor advised fund? That's really what I think will come out of this. There probably will be donor advised funds are instead of a private foundation, you're giving to this sort of public charity, and you hope everybody knows what they are. They've been very popular, been growing. I work for a family wealth office. Besides consulting and being a lawyer, I work for one family wealth office, and we have 2 foundations. But they're creating, the newest thing they're creating is donor advised funds. because they're very easy to manage, and they're going to be each child significant amount of assets, and each of them will have a donor advised fund. So donor advised funds are very popular, and I think they'll become even more popular, particularly this year. And I think my guess is people will take a look at this and they say, well, these things won't last forever. They'll probably change in a couple of years. So people might put away a couple of years of giving into a donor advised fund. How does it affect you? Well, you should know what a donor advised fund is. You should feel comfortable with it. It's good that, if a donor of yours, supporters have donor advised funds, which they may, you'll know because their gifts come from Fidelity Gift Fund, or they come from a Jewish Federation donor advised fund, or some other entity that has donor advised funds. And it means that money's already been set aside for charitable giving, but it's up to the donor when they want to make the distributions. So I think that is a definite possible likelihood for higher net wealth individuals who are going to feel this a little bit. They're not going to. It's going to be very hard to calculate what the actual impact is on people, but once they get wind of this, and I would never try to explain this to a donor. And I'm a tax lawyer. I don't want to get into that business. I would just say that yes, the government is starting to take some of the value of your deduction away, and if it bothers you, you could put away a lot more this year in 2025 in anticipation of avoiding, you'll get the deduction now anyway. And that's an advantage of a donor advised fund in any case, with or without these changes. So we should definitely spend time understanding donor advised funds. So essentially I concluded, for those whose income is exceeding the 35% bracket, they lose $2,000 per every of deduction per every $100,000. So that's basically. So like I said, they would get it gets almost impossible to really figure out what it all means, because it'll take time. There is another thing here, and this is related. That's why I put it on the slide. They made permanent the previous tax bill back in 2018 had bumped up, or maybe it was a different bill, but anyway, around that time they bumped up the limit you can make for deducting any one given year. So currently the rule is, and they made this permanent, is that you can deduct up to 60% of your AGI, of your adjusted gross income. Obviously, people can afford to do that in any given year. Obviously, these are people who itemize. That's now permanent. It used to be 50%, and that's only for cash gifts. If you make gifts in stock is important to accept. So the donor who gives stock gets to avoid capital gains, but they only can deduct up to 30% of AGI in 1 year. And if any donor really gets that high, because obviously, I always use example, $100,000 AGI, the person is giving $60,000 of it. This doesn't make a lot of sense, but it does come about. Sometimes it is an issue. But in any case, anybody who really can't use the deduction up in a given year because they've gone above 60% of their AGI in cash gifts, those deductions are not lost. They roll over into the following year. I had this happen not that long ago. I had a donor decided to part with his house to his medical school. He's a doctor, and he decided to give his house to his medical school, but he did what's called a retained life estate. So he's going to live in his house the rest of his life, and he has to take care of it and pay taxes and all that good stuff. But the medical school owns it upon his passing. That's a classic plan gift called a retained life estate. And anyway, he got a pretty big deduction. He got about $500,000 deduction on a house worth about $800,000, and so but he wasn't able to use all the deduction up, and it would take several years for him because he retired a year or two after that. So in the first year, on $500,000, you'd have to have close to $1 million in income to be able to use it all up. So hopefully he used it up, but he stopped complaining about that. He was a little upset about it initially. And I think the big takeaway from the bill for us for fundraisers is a charitable deduction for non-itemizers. So let's just go back into that. All right, so it's a new permanent rule, means that it doesn't expire. Okay, great. This helps for those who don't itemize, and this is again, it used to be. I took out the slides. I had a bunch of slides on this. I always track these numbers. Before the 2018 tax bill, about approximately 30% of tax filers, 30% were itemizers, and 70% of them were non-itemizers, according at that time. But by the way, the 30% who were itemizers represented like 80% of charitable giving across America, so it was pretty top heavy. And I just want to make sure there's no questions. Great. In any case, then all of a sudden the 2018 tax bill happens, and now only 9% of tax filers are itemizers. So we were very concerned that people might slow down their giving. They're not getting a tax benefit, but it's not, I don't think people really think about it so much. It didn't really make a difference. So they tried out a non-itemizer, deduction in 2020 and 2021. By the way, in 2001, when the Bush administration was pushing their big tax cuts from 2001, I was working for United Jewish Communities, and they asked, they got through to me because I was the lawyer for United Jewish Communities. And they, well, what do you guys think? We want to propose a non-itemizer tax deduction. At the time, I was like, I didn't want that. I want direct giving from IRA rollover giving, which we'll talk about in a second. And it's something, it's funny how there's certain in the political world they were obsessed with this. We got to get a non-itemizer deduction. So they tried it out in 2020 with the CARES Act for only $300, and then they did it only worked for people who were no longer itemizer. If you're not an itemizer, you still get your $300 above the line deduction. And in 2021, they doubled it to $600 for married couples who file jointly, $300 per individual. And it was not that impressive because, I mean, if you took the standard deduction, your number of tax returns, the 41 million, and in 2021 it jumped up to 47 million, almost 48 million people took the deduction. But the total percentage, just look at the percentage, total percentage of giving in America in 2020 from non-itemizers was probably about 3.3 million, according to the IRS stats. And then 2020 bumped up to 4.6. But I'm still hoping that this non-itemized deduction will be sort of people should, at a minimum, why not do it? It's a straight deduction. They're going to get benefits from it. So hopefully, we'll talk about how we can talk to our donors about this, or what we can promote to them. So I think it's and you guys can ask questions after, but I think that the non-itemized deduction is definitely something worthwhile to put out some information to your donors. And I think one of the takeaways from today is we're going to send you plangiving.com. I'm going to tell them that they owe this group some examples of what some marketing examples, things you can try to educate people. I think it's not that you'll get so much more money. You might not get more money, but it's just a good conversation starter, a good way to engage your donors, and it's helpful to them. And now a couple other things here, just so if you didn't notice, there was a discussion in the campaign. Oh, we don't want tax tips, so they had to find a way to not tax tips. So they put a limit. If you your adjusted gross income is above 150 or 300 for joint filers, you don't get any benefit. Sort of phases out when you hit that around, start hitting those income levels. But for those making less, you're not going to get taxed on up to 25,000 for tip income, and then also for people who are overtime people who get overtime compensation. Again, you're not going to have to file for up to 25,000 for joint filers. Okay, and again, it just phases out once you get to higher income levels. Yes, and then they also, this one's to be seen. I didn't know what this actually means, but auto loan interest deductible will be deductible for itemizers and non-itemizers for new cars with final assembly in the United States for tax years 2025 to 2028. So I suspect that car companies that do the final assembly in America will say, hey, you get a bit of a deduction, but again, I'm not going to worry about that. Just to mention, because I'm in Plan Giving, and Plan Giving, is also about estates, including charities in your states. And what about the estate tax? Well, they bumped up the lifetime estate and lifetime gift tax exemption. I'll explain to you what that means in a second. To 15 million per single individual, or 30 million for joint filers, beginning in 2026. What this means is during your life, gift taxes only apply when you're alive, or in your state, you can give away up to, each of us individually can give up to 15 million. If you have a spouse, it goes up to 30 million to anybody you want. It could be your children. You're not talking about charitable giving, because charitable giving doesn't get taxed. and you pay no state tax. And now, it used to be when I first got into plan giving, the limit, the exemption, that lifetime exemption was $600,000 in 1998. Once you hit $600,000 above that, you start paying some estate taxes, and this has been totally changed over the last 25 years, dramatically. First Bush presidency somehow got it to got it down to bumped up way high, and then expired, and they redid it, and then in the previous tax bill, 2018 Trump tax bill, that one, they bumped it even higher. They doubled it. Now they're making it really high. And again, this is another one of these obsessions, political obsessions. Somebody, maybe the donors or somebody's like behind the scenes saying, we really need this, even though it's such an easy tax to avoid if you want to do anything charitable. Because if you're charitably inclined, I could avoid all this potential taxes on your estate. But they did do it. By the way, less than 0.1% of estates in the U.S. pay any federal estate tax. In 2019, only it was about 0.08%. Really, very few deaths resulted in any taxable estates. It's a very, very small amount of people. Now, it used to be about 2 to 3% in the early 2000s. Now it's well under 1% of people who pay estate taxes. So basically, like I say, what we mean, we say 0.088%. That's 8 out of every 10,000 people, or 1 out of every 1,250 people. So it's not an issue. So estate tax, for all intents and purposes, is no longer an incentive for plan giving, because then anyway, people, once they get to the 15 to 30 million mark, they're using more sophisticated estate planning programs and lawyers and stuff, and you're gonna get less incentive for plan gifts. So essentially, plan giving incentive regarding estate tax is just no longer an incentive. All right, so my last slide, and then we'll just have conversations. And there are a couple things I kind of skipped, and I think I'll mention them here now. So the tax bill actually has some good things in there. I just say, obviously, if the economy does better, that's good for not-for-profits. I know I've been yelled at sometimes because, well, that's not the smartest thinking, but it is generally true that if the economy is doing better, giving generally goes up. Because I don't know if you noticed, but on the first slide, I always track the percentage of giving of disposable income. So it hovers between 1.9% and 2.1% of disposable income being given to charity year in, year out. So if people have more disposable income, more disposable wealth, they give a little more. And if they have a little less, they give a little less. That's pretty typical. But I think the big deal is this non-itemized deduction, which I hope you guys will ask me some questions about it. I think it's a good opportunity to engage your donors. It's definitely, and on top of that, I didn't go into it today, but I would put the non-itemized deduction, I'd market it along with direct IRA giving, called the IRA QCD, Qualified Charitable Distribution Giving. And that only applies, direct gifts out of the IRA only applies when you're 70 and a half and older. And so it only applies for somewhat older donors. But in any case, people, as they get older, are much less likely to be itemizers, particularly if they're no longer in the workforce, particularly if they've downsized, they're no longer in a big house, paying a lot of taxes on the house, things like that. So I put these these are two, because non-itemized deduction and IRA QCD giving are both ways you can give and get a really nice tax benefit, even if you're not an itemizer. And that's really one point I want to make. And then I didn't go into, I took out the slides on vouchers for private school scholarships. Now, they're not real vouchers, but basically what they're creating is what's called a tax credit. I don't want to go into it too much, but and it gets, I think it's like a test type program. They're going to give individual can give $1,700 to a scholarship charity. It has to be a scholarship charity. It can't be just a school. It has to be a scholarship charity. So if you give $1,700 to a scholarship charity, you will get a $1,700, that's the max for individuals, $1,700 tax credit. So basically it's a wash for you. And obviously husband and wife can do $3,400. And the grandparents could each do, if it's two grandparents, they can do $3,400. And it doesn't cost the family anything. Now, every time I talk to people about this, they say, well, yeah, but the school's just going to raise their tuition by $3,400, or raise. So this is for private schools. But anyway, it's for those who it affects, it's pretty revolutionary, but it's to be seen how it's going to play out. Now, that's good. The bad, I don't like to say bad. bad or very bad. Okay, the bad. I really don't like taxing of charitable deductions. Basically, that's what I was trying to explain to you before. This 0.5% floor and then the 35% ceiling. Very hard to understand exactly how those play out, but it's basically taxing. It's a way to tax charitable deductions without calling it a tax, which is very annoying to me. And this is not the this was in the Obama administration was also proposed similar things, and when they had some potential tax bills, it didn't get passed, so it didn't come up. And then there was something. This was previously done. I don't remember which party did it in the 2000s. There was something called Peas, which was the exact same thing. And this is a trick that those who do these big tax bills utilize to try to make their numbers work, and it's just we're not too happy about it. I don't know if it'll affect giving, but we're not happy about it. State taxes again no longer used for planned giving. Okay, we'll see. At one point I thought the state tax was gonna if it went back to if it expired, hadn't got that bill passed, and then there'd be a huge huge discussion about, oh no, we got this, the state exemption is going to go back to $3 or $4 million from its current level of 15 million. So would have been a lot more to talk about for plain giving people. And then the ugly, like the really not good stuff. I didn't go into it. There's the excise tax on not-for-profits, which had to do with the top universities who have certain amounts of endowment, holdings per student, and or taxing basically excise tax on highest employees. You have a bunch of people making above $1 million from your not-for-profit. There's going to be a significant tax. Okay, so and again, I'm not going to go into that because it's not really relevant to fundraising, especially this audience is environmental groups as opposed to universities. Okay, so let's see. Did I hit my last slide? Yeah, last slide. So that was. Let me stop the share. Okay, I don't know. Was it? I wasn't watching your faces, so I didn't know if you guys were like, oh no, what is this? I don't know. Anybody have questions or any discussion points?
Jonathan, this is Denise. I'm with the Alliance for Morris County Parks.
No, Lamar's County.
Support the Morris County Park System. So just trying to double check some of my notes that I wrote here very quickly.
Yeah.
So I understand that 35-cent primarily is like the high tax bracket.
It only applies to any income is going to be taxed at 37%, which is the highest level. And
Right.
that means, so even if I was making $500,000, I'm not yet even at the 37% bracket. So if I make 600,000, I still spill into that bracket, but it only affect my income that's above in the 37% group. So you have to make like $1 million a year or more for this to become like kind of annoying. And if you're making like 10 million a year and you're giving a lot of charity, this will become more and more annoying. Really, really.
And so then that 0.5% too, is that also those high end brackets?
Oh, so good question. Good question.
And do they both hit, I guess, is the question. Not that I have donors at that level, but just kind of an interesting thing to know.
So hold on 1 second. Give me 1 second. I just want to go back to my notes on that one.
Yeah.
The 5%, wait, the 5% floor kicks in. When does that kick in? Can't hit everybody. Maybe it does. Maybe it does. I don't remember.
Okay.
So it's a really good question. I don't remember the answer. I think it kicks in for everybody, but if let's say for me, like let's say I just do my 24 tax. Let's say I'm deducting $10,000. Like I lose $50 of deduction.
Okay.
I mean, I guess that's what I'm saying. It doesn't at the lower amounts, even if it affects lower amounts, it's not going to be something that it's not going to be something that people are really going to pay attention to.
Okay.
So, but at the higher levels, it does seem to be a bigger issue.
Mm-hmm. So I guess if I could jump in with another follow-up, I'm just trying to figure out, since we're coming to year end, and we all probably do something for Giving Tuesday or our year-end annual appeal, what do you think are, and again, I don't want to talk for everybody, but I don't draw too much from $500,000 donors.
Yeah.
So if I have, my average donor, what might be the one or two things that I should pull into my year-end appeals or my year-end newsletters or things like that to kind of counteract some of those things that are out there that people are hearing in terms of what the, the OBBB bill did, for their income and what they're thinking about with making donations.
I mean, I think just on the positive end, I do want to make sure people, if you have a chance to mention, oh, by the way, if you're 70 and a half and older, you can give out your IRA. It's always available, and it's already, it's always good to keep that in front of people because it takes a while for them to sort of let that sink in, and so I would push that out. I'm not a big, I never liked the doom and gloom stuff. I think us as a not-for-profit world just need to be positive and just say, hey, now you could say, you could mention, by the way, the environmental community is, a little bit under strain. I don't want to say like, I don't want to go extreme, but I would just say, hey, things are really tough and we've lost some of our other sources and we really need your help. I would just go with the emotional appeal that we really, this year more than any, and I wouldn't get involved in these details. And a lot of others in my field, competitors of mine or people in similar positions, are trying to, oh, you have to tell people to double up their gifts this year. So I just don't feel like that's gonna work. I just don't feel like that's a good message. It's complicated. And if anybody is upset, they say, wow, I'm really mad that my deduction is not gonna be so great in 2026. They can go ahead, they'll probably just do a donor advised fund. They're not gonna they're not gonna give you multiple years contributions. And that's everyone's saying, what about multiple year contributions right now? Because then it could get a little bit better deduction. I just don't think it's worth it. I think more of the emotional impact, definitely the environmental world is definitely, there's a lot to say that there were a lot of cuts. You don't have to be specific, but
Yeah.
it will affect you. And I think that's probably the bigger message that, hey, we are under strain and that we could really, every penny counts. And and if you're 70 plus, you can give from the IRA. And of course, once the IRA, the non, did I say that hold on, the one important point, I did say the non-itemized deduction is for 2025. So I would also put that message that would say, hey, by the way, that would be above the IRA giving. I would say, hey, this year you do, due to the new law, everybody gets this $1,000 or $2,000 deduction that, regardless whether you're itemized or not, please take advantage of it. And what I'm going to do is, if Lauren is okay with it, we'll people from plaingiving.com are putting together a lot of different materials and stuff. So we'll see if something to share with everybody, some language and stuff that you can put into your publications that says, this is something that everybody should remember. We want to tell people, hey, you get a nice deduction. So maybe you want to bump your gift up to $1,000, or husband, wife, maybe you want to bump to $2,000. Not sure you'll see too much of that, but you might see some. It's definitely a good message, but I wouldn't be like the lead message. That'd be the second.
Well, I think, we would all hope that people are not making donations to us, or most of our donors are not making donations to us for the tax credit. They're making donations because they connect to our mission. They believe in environmental and sustainability and preservation and parks and, water and air and things like that. So, but I do think it's so much has been made about this that I think we need to address it, even if it's just 2 or 3 little bullet points. I think for me, one of the other things that I'm going to include, because I have received gifts from DAFs, is to actually point out if that's something that you have, make that.
Yeah, DAS may get more and more popular. I don't know if you have any there are DAF widgets. I haven't been directly involved with them, but you can put on your website like a way for people to give. There's a couple, look up online, DAF widgets. So there's a couple versions out there that you can put on your website also that'll help people go get them right to their donor advised fund so they can give you money out of the donor advised fund. Yeah, definitely donor advised fund are getting more and more popular. And that's for sure. Again, I don't think it's gonna be the prediction of everyone's gonna put money in donor advised funds. I don't think that's the case, but I think definitely there'll be more and more of that. And, yeah, you want to try to mention that. Like I said, we're gonna send out. They're not done yet because we're doing another big presentation on this in about a month, so there might be a little time. But I'll ask them to send out to give it to us so we can share with everybody the some of the takeaways, but again, I mean, we're in the plain giving world, like like it's our business to stir things up and say, hey, we this is exciting. Now you got to hire us to market it for you. I mean, I'm not a marketer, I'm a lawyer, but that's what these companies do. So I'm not like, I'm not freaking out about it. I am very disappointed that they went ahead and pulled off this basically taxing charitable giving. I thought that was really kind of silly. And in the end of the day, it's probably not going to amount to much. Like it really won't be very much at all. Like I'd be surprised if it costs anybody more than a couple $1,000s. Like I have this client who's a billionaire. So I have this very big client, and he hasn't had to give much to his foundations because he already gave like $50–100 million to his foundations. So next year he might, at a certain point he's ready to give to his foundation, but like, I'm not going to discuss this with him. I mean, his cat will not discuss it with him, and he will not know. He's working on the next $1 billion. He doesn't care about, if he wants to give money to charity, he will make sure he gets a deduction. And then timely wise, they might do it in a year. He's got a lot of income, but he's not gonna change much of his behavior in that regard. But I definitely agree with you. You do want to put it out there. Hey, there's been some tax law changes. You can but keep it really simple. Do not get sucked into trying to do anything complicated, because I'm a lawyer and I'm the complicated guy, and I can't even explain exactly how it plays out. I spent a lot of time on this. I feel like hours and hours. I was like, fine, no one's gonna understand it if I really try to explain it. I'd have to walk through the Excel spreadsheet. Just wouldn't go anywhere. So, but I mean, sometimes I had an old boss of mine who say, problems is always an opportunity. So, this is an opportunity for us to say, hey guys, there were a lot of changes, a lot of the stuff impacted the environmental community. We really need your help. And there is a new non-itemized deduction which you can take advantage of, and you may be considering donor advised funds, and we'd love to have a conversation with you. And just if you have anybody calls you, oh no, they called us. Say, oh yeah, we have somebody. We'll reach out. You can reach out to me and figure out how to answer their questions. So, if there were a lot of questions coming through, that'd be great for me. So I wish that. I only wish that everyone, is stuck and has to call me and says, get the answers. But unfortunately, there'll be probably very few. I'll be honest with you. Let's see what else. Let me ask you a question. Your Morris County parks. So what's the biggest Morris County park? The Torn?
No, actually, I would think Malon Dickerson Reservation in Jefferson.
Oh, that's
about
far.
2,200 acres.
Yeah, that's far out. So in Parsippany, that was a little far for us.
Yeah, no, Torn's a good one. You got a little, I call it little, Old Troy Park in Parsippany.
I'm laughing. I grew up in Old Troy Park. That was my.
Okay, all right. Well, I call it little compared to some of ours, but yeah.
Adjacent to my neighborhood. I spent
okay. All right.
Around Old Troy Park.
Cool.
If you walk in the middle there, my brother and I carved our names in one of those trees where it grows and expands. So in 1978, we carved our names in a tree. So
my gosh.
It's
okay.
probably very, very expanded.
I'm sure.
Oh yeah, you're right. Yeah, Old Troy Park's not so small. It's a pretty big park.
Yeah, I'm just saying in terms of when I think of our parks, like Lewis Morris Park.
Yeah.
1,200, 1,400 acres, Jefferson, 2,200 acres. I think of Old Troy, it's just kind of there in that residential area.
Yeah, a little small.
No, it's not that small. It's a good walk through some of the hiking trails. Yeah.
Yeah. It's not a very, Old Troy is not a very, it's not like a destination. It's for the neighborhood people in the area. They just,
right.
Your dog, go walk through there.
Yeah. Yeah. I think Malon Dickerson's more of a destination, even Central Park, which is like, we think of as our active park, that's more of a destination because there's so much going on.
Yeah.
Schooley's Mountain in Washington Township, that's another destination park. I just think,
I have to go to everyone's website.
Do the hiking.
Yeah, I have to do some more research to find some good hikes for us.
Yep.
Anybody else have questions? No.
Jonathan, question: how or if the charitable remainder trust or charitable lead trust will be impacted?
That's a very complicated question. The answer is, I'm going to tell you something before I even answer the question. Very few of them are ever done. Like, very, very few of them are ever done. Like they're like in the charitable plan giving world, there are still gift annuities being done, but a lot less. Gift annuities are a very simple version of these.
That was my next question.
Yeah, so the answer is, unfortunately, my business affect my business. There's just not a lot of them being done, and I do. I see someone say they look forward to seeing materials. I think that there'll be no impact on them at all. I just don't think the impact. I mean, I really wish that there was a lot more of them happening. And just it's a lot of the reasons charities have gotten too nervous to do them, or they close down their programs, and charities stopped investing in them. You stopped investing in the marketing of these vehicles. And I have clients, they're still clients of mine, but they stop promoting them. And they said, we're not going to promote them at all. If somebody comes through, we'll deal with it. So there's so few of them. So I don't think there'll be any impact on charter member trust, charter lead trust. They do come up in a more complicated estate planning situation where somehow this is a good fit. Great. I'm working on one illustration right now. Lead trust, I've done a bunch of those, but they're still very rare. By the way, if any small charity has a donor, more likely it would happen if a donor comes to you and says, hey, can I do a charitable gift annuity for you? Or one of these charitable annuities for you. So you can always use the National Gift Annuity Foundation. Almost all my clients use them. And you can look them up, National Gift Annuity Foundation, NCGA, something, National Gift Annuity, NGCF, National Gift Annuity Foundation. So I'm friendly with the guys who run it. I don't get paid for it. I promote them because they are the guy who created it was like the risk management guy expert in the plain giving world for many years ago, and then he runs it a very conservative, very straight way. And basically it's just you reach out to them, they'll give you an application, you share it with the donor. You can help the donor fill it out. So I've done that basically the last couple of years. Almost all the gift news I've worked on were through National Gift Annuity Foundation. And I basically, even as a consultant, I may do the initial illustrations, but they could do the illustrations too. You don't even need a consultant. So that's So I don't think there'll be a big impact in that regard, unfortunately. But it's just the way it's changed. The field was, when I got in 1998, it was very big into this. I was doing tons of these things, and over time, it's just gotten less and less. And so I don't think tax bill affects that at all. I don't think there'll be any differences there. And be great if you get some of them. Why not? So call them again. I always offer. If you got somebody who wants to talk about something, I'll do a pro bono phone call with anybody who wants to do one of these vehicles, and you'll see. But one of my clients asked me for illustrations on a charitable remainder unit trust, which is the income varies year to year. And I try to tell her, I was like, why are you even asking for why don't we just present the charitable remainder annuity trust? And then that I just gave up with the argument with her. I just gave her the illustrations. But I was like, I've been on the inside of these things, and years later, usually everyone's unhappy with them. If it's an annuity version, then the income's straight and it's very simple. But you get the unit trust version, every year someone's supposed to reassess it, and then they forget to reassess it, and then it just becomes a bigger and bigger headache. And I have one now that was started about 30 years ago, and I'm the trustee of it. And I'm just negotiating with the income recipient. It wasn't even him, his mother, and just to end the trust and give him whatever he's entitled to, and just distribute the rest of the remainder to charity. It's like, well, why is he bothering with this? So okay. Any but good questions though. Thank you for asking.
If you can, love to see the new version of the conversation by Plan Giving and yourself coming up in a month, so we can promote that to everybody in the group.
Oh, good. Well, I'll tell Viken. I don't know if you were in touch with Viken. I think you reached out to him originally. Yes, I'll tell him that I promised that we should send out some materials to your group, and he'll be in touch with you about. I'll put you guys back in touch with each other, and then also let you guys. He has to confirm the date. I think we're going to do it pretty soon. I think we're going to do October 30th. I think that's the current plan, but you never know. You never know how soon they'll do it or not. But the goal of that one will be a little more detailed and to try to make sure that all the fundraising world is equipped to, if need be, to be able to talk to these things, talk to donors about these things. So definitely more in depth than what I covered today.
Well, thank you. We really appreciate it, and looking forward to hearing more.
Okay, yes, our pleasure. All right, so thank you everybody and for joining in, and share the recording with the whole group. Hopefully others will get to watch it.
Absolutely. See you around, Jen and Denise.
Yeah.
Thank you, Jonathan.
Thank you, Jonathan. Appreciate it.
Okay, thank you also for having me.